Hey guys, it's Liquid here. This video I wanted to make a little bit special and more personal because it's to celebrate my 500 subscriber milestone, which is all thanks to you guys. So I'm going to break down my entire investment portfolio and share the lessons that I've learned along the way investing in these asset classes. This video isn't about providing stock tips or investment advice, and it's not about comparing anyone's financial situations. To be frank, my portfolio is nowhere near as impressive as other personal finance YouTubers. Instead, what I want to do is just talk you through my thought process behind what assets I have and why I have them. And then maybe you can learn something from my investment experience over the last 12 years. So, from a high level view, you can see I have two rental properties, and combined, they make up about half of my portfolio. That might seem like a little too much, putting 50% of my asset allocation in real estate, but I will explain why this makes sense to me in a bit. And then I have about 20% allocated to Canadian stocks, another 16% for US and international equities. I have a fixed income portion, which is mostly made from bonds, MICs or mortgage investment corporations, and peer to peer lending. I have cryptocurrencies as well, making up about 3%. And finally, some alternative investments like precious metals and collectibles, making up the last 3% of my portfolio. So, why do I have my portfolio set up this way? Well, last year on my blog, I predicted that we were going to see higher inflation because of all the money printing. More currency chasing after the same goods will lead to higher prices. And it was that same summer that I bought a new house, and I was deciding should I sell my old place, which is a two-bedroom condo, or should I just rent it out? Because real estate is a great hedge against inflation, I decided to ultimately keep the property so I can get an upside benefit when inflation runs high. Another good long term hedge against inflation is stocks. So that's why stocks make up a large portion of my portfolio as well. So that's kind of the framework behind why I have my asset allocation set up like this. It's a mix of high quality assets that I understand. It has some variety in there to balance out the concentrated risk, but should also generally outperform in a high inflationary environment. So I'll go through these one by one, starting from the top and then going clockwise. Starting with my two-bedroom apartment, this I bought in 2009 for about $220,000. Based on the latest government assessed value, this is worth 450,000. So that's like a doubling of the value in 12 years. This was my home from 2009 to 2020. And like I mentioned, instead of selling it after moving out last year, I decided to keep it and rent it. Because I bought this so long ago, the cash flow is positive at $700 a month. Another benefit is I can continue to capture the future growth and capital appreciation of this property. I also learned not to sell from other people's mistakes. Last year, the Globe and Mail's financial columnist Rob Carrick mentioned that one of his greatest financial mistakes was not keeping his house when his family moved. And if he had just rented it out and kept it, he could have sold it later for 4 to 5 times what he initially paid. By learning vicariously through other people's experiences, I think we can become better decision makers and better investors. So, if you're ever in a similar situation, you really want to think carefully about whether or not you want to sell your old place. For large cities like Toronto or Vancouver, the population is expected to grow by 35% over the next couple of decades. The friction costs are high for real estate, so it's just something to think about. The next item in my portfolio is a one bedroom rental apartment. It is in a newer building, which is why it's valued at about the same as my other place, even though it's smaller. I bought this in late 2019 when I wanted to invest in something that was recession resistant and could also produce long term stable income. This one barely cash flows, even though I used a 30% down payment, but it's in a great location and I expect there's going to be a lot of room for capital appreciation as the neighborhood undergoes further development. And of course, real estate is very local. I've basically spent my whole life in the greater Vancouver area. I'm familiar with the different neighborhoods. I know and worked with different realtors. I've dealt with city permits and bylaws. I've also built a team that can help me manage these properties. This gives me an edge when investing in real estate in the lower mainland. So, this is a special case for me, but I wouldn't suggest to my friends to put 50% of their net worth in just one asset class, unless they also have really high justified conviction in that field. The next major asset class I have are Canadian stocks. Over $100,000 is in my tax free savings account, and the top three holdings in my TFSA are Premium Brands, Royal Bank, and CapREIT. Premium Brands is a food manufacturing company in Canada and the US. I bought this stock about 10 years ago, and it's been one of the best performers in my portfolio, up about 10 times if you include the dividends. I like Canadian banks, and Royal Bank is definitely up there in one of my favorites. And CapREIT is a real estate investment trust that focuses on residential apartments and is the largest of its kind in the country. I also have a retirement account, RRSP, which holds a lot of Canadian companies as well. And then I have my margin account, which transitions into the US stock portion of my portfolio because I hold both Canadian and US in the same margin account. With interactive brokers, it kind of lays out a nice graph for me so I can see, at the beginning of the year, there was $200,000. And then I put in only $4,000 this year because I was trying to max out my registered accounts first, TFSA and RSP. So I didn't have too much money for my margin account, but just managed to put in 4,000 and the current net asset value of my portfolio is $295,000. Now, this is not how much stock I have. That's the net asset value. So down here, the allocation, this kind of gives you a better picture of all the Canadian and US stocks and ETFs I have with a total of $409,000. So that's kind of the total amount of exposure I have. And then on the right here is my cash, which is a negative number because I am borrowing on margin. So if you take how much stocks and ETFs and everything I have minus the amount that I'm borrowing or that I owe interactive brokers. That's how you get the 295 here for the net asset value. The Sharpe ratio here gives you a good idea of the risk adjusted return of your portfolio. So if this is, you want to just keep track of this over time to see where it's going. Usually if it's above 1, it's a good number. Above 2 is very good. So if you track your Sharpe ratio over many years and it's consistently above 1, then that means you're doing something right. So you should probably continue to invest the way you're doing. But if you're getting a lower number, then it's probably time to rethink, how you're investing. See how you're doing relative to the index and make adjustments if you need to. And I would do that no matter how you're investing, whether it's value investing, index investing, dividend investing. Keeping track of your investments is one of the best ways to learn because you can just reflect on what you did before, make changes, and get better results next time. And it's an iterative process. So the longer you keep track of your investments, the better you're going to be at making your next investment decision. In terms of what I have in my margin account, my top 5 holdings are TD, Amazon, Canadian Natural Resources, Deere, and Match. I have sold a couple of call options on TD and C&Q, so there's a chance that some of my shares of those companies will be called away, which is probably not a bad thing because I'm very overweight in them, as you can see. TD takes up like 12% of my margin account. Thanks to the higher price of oil, Canadian natural has gone up like 50, 60% this year so far, which has been an incredible run. John Deere is a really good brand, and they make money from selling, financing, and servicing. I blogged about Match.com when it first went public, and I decided to buy some at the IPO because I studied the company and thought it had a really clever and lucrative business model. And maybe not surprisingly, these 5 stocks have also gone up the most in my portfolio. But not all my stocks have gone up. If I scroll down here, we can see my biggest losses are Cineplex, of course, movie company not good during COVID, and a couple of oil companies, Halliburton and Crescent Point Energy. Both of these stocks I liked before, but Halliburton had that big oil spill accident, and CPG just had too much debt. What I liked about it before was the 6% dividend, but after the stock crashed, it cut its dividend, and I should have gotten out earlier, but now I'm just holding the bag. My initial investment was 1,600, and now that is worth 442, so that's down quite a lot. So the lesson is do not buy a stock just because it has a high dividend. Looking back, I now know there was no room for the dividend to grow. Crescent Point had a lot of debt and they were overvalued. So I try not to make the same mistakes once I've learned from them. Picking high quality stocks is not always easy, but overall, I think the time to do the research and due diligence for me is still worth it to buy individual stocks. Because if my worst performing stocks drop by 70 or 80%, but my best performing stocks give me a 5 or 10 times return or even higher, then it'll still be a very good overall outcome. I did mention margin debt earlier, which I use in this account. I'm currently borrowing just over $100,000, and this is at about 1.6% interest rate, so it's really low. And that puts my leverage at roughly 1.4. It used to be higher at around 1.6, but because the stock market has gone up so much over the last year, the amount of money I owe compared to my overall stock portfolio size has gone down. For a lot of investors, they take on more margin debt as the stock market goes up, which kind of makes sense because you have more equity to borrow against. But I kind of take a contrarian approach where I lower my leverage used when stock markets are going up, especially if it's because of PE expansion. Because if markets are overvalued, that means they are likely to produce a lower than average return over the next 10 years. And I have a harder time borrowing money to invest in something that'll give me a lower expected return. On the other hand, when the PE ratio compresses and the stock market comes down, then I would be more comfortable using more leverage, and I can use 1.6 or 1.7 leverage at that time to just throw money into the stock market. And that's what happened in March of 2020. Warren Buffett has a leverage of 1 to 1.6. That's generally a good rule of thumb to follow for my portfolio as well. Moving on to fixed income, this adds stability to my portfolio, and I can always sell some of my bonds or other fixed income assets to buy stocks whenever there's a stock market crash. The largest bond ETF I have is ZCM, which is a medium term corporate bond ETF from BMO. It pays out about 3% a year in interest after fees, and I'm mainly holding it as a strategic position to dump and put the proceeds into something more attractive when the time is right. I have some short term bonds as well for the same purpose. Another large part of my fixed income strategy involves investing in mortgages, and I do this through mortgage investment corporations, both private and publicly traded companies. I don't expect much capital appreciation from this sector, but it's mostly an income play. With a total MIC portfolio of $45,000, I'm generating about $3,000 a year in interest income. And finally, there's peer to peer lending. I'm using Lending Loop as the platform. It was doing pretty well a few years ago, but recently I've been getting low single digit returns, so I've been thinking about divesting from this a little bit. The returns are just not worth the risk anymore. Moving on to cryptocurrencies, I'm mostly holding Bitcoin and Ethereum and playing a little bit with altcoins. I'm not sure where Bitcoin will go in the future, so it's still very much a highly speculative asset for me. But sometimes I just have to put my you know what on the line because unconventional returns require one to take unconventional risks. I like to use Binance to buy the less well known coins. I think the platform is easy to use and I can quickly transfer any coins to the Trust wallet on my phone. For the major cryptos, I like to buy them using Shakepay. I like how they give me free Bitcoin every day when I shake my phone. It's not much, but it works out to $20 a month, and that's free money, so why not? Plus, the pay increases the longer I keep the streak going. They also give you $30 if you're a new user and you buy $100 of cryptos using their platform. So that's a 30% guaranteed return on your investment. Of course, Bitcoin is very volatile, so even though you're getting $30, you could still lose like 20% of your investment if Bitcoin were to fall 50% by the next day. So make sure you understand the risks before putting your money into anything. There are some conditions you have to meet as well, so I'll put it in the description below and you can check it out if you're interested. And finally, I have alternative investments, which includes everything from my gold and silver collection to some Zimbabwe banknotes I have. I also have 6 bottles of French wine sitting somewhere in a storage facility. And I have a video game collection spanning multiple console generations. So that's a look at my overall portfolio. By the end of next year, my goal is to grow this to be worth $2 million. Keep in mind, this is just showing the assets. The debt with my mortgages and the margin loan is not represented in this pie chart. Having low interest debt allows me to leverage my portfolio and potentially make higher gains. In terms of rebalancing, I typically don't like to sell any of my assets unless there's a better alternative. For example, some people are predicting Bitcoin could go to $500,000 in 5 years. And if that happened, maybe cryptocurrencies would take up 10% of my portfolio. Will I sell some at that time? Probably not, unless the reason that I bought Bitcoin has changed. Instead, I like to rebalance by just adding more to the asset class that I'm underexposed to. So, hopefully, that gives you a better idea of what kind of investor I am. I think high inflation is going to stick around for a while, so I'll continue to be bullish on the stock market and real estate. I favored growth stocks for many years, but I've been buying more value stocks lately because I think they have more room to grow over the next decade because of their more attractive valuations right now. Emerging markets also have some pretty cheap stocks compared to North America. I made a video about emerging market ETFs if you want to check that out next. And don't forget, I now have a community tab thanks to subscribers like you. So if you want to see more frequent updates or what I'm up to, you can head over to my channel to take a look. And maybe I'll see you there.